Okay, ladies and gentlemen, this week is your main event of really at least the next couple of weeks. We do have the Jackson Hole Economic Symposium, and Fed Jerome Powell will be giving his infamous speech this upcoming Friday. And yes, this could cause the next 5 to 10% move in our markets. So this is a big deal. In this video, I will give you a breakdown of what could be said, what should be said, what will be said, and how markets can and most likely will react to this. As you know, we also have earnings this week, and I will share with you what companies report and when. We also have some economic data this week, but not too much for Monday, Tuesday, and Wednesday. So the main events are Thursday and Friday. As you also know, markets have rallied about 9% off of the lows. It's fascinating. We fell 10% quickly as I expected, a 10% correction, and then you just got it all back. Almost all of it back. You're up 9% from the lows, and there is definitely some upside momentum here. We had retail sales come in better than expected. We have GDP estimates that are still sitting north of 2%. Initial jobless claims have fallen for 2 weeks in a row. This Thursday will confirm whether that's going to be 3 weeks in a row or not. It looks like the Japanese carry trade is done unwinding. The margin calls have slowed down, and the equity selling in the US and really on a global scale has all but stopped. There are some positive things happening under the surface. But I guess the real question is, did we bounce too far too fast? Now, some would say we sold off too far too fast, but usually you don't get these V-shaped recoveries, just one fall and done during these volatile periods in markets. And we have to acknowledge this. The next couple of months are going to be extremely volatile because the Fed's going to change their projections with each data point coming out, or at least the markets are going to project the Fed is going to change their path of the Fed funds rate. Less cuts, more cuts based on each bit of incoming data. So there's going to be a lot of volatility around that. There's going to be a lot of volatility around each data point. I'm expecting some data is going to be really good. Some data is going to be really bad over the next couple of months. So that's going to cause a lot of volatility. And then at the same time, you also have the election and geopolitical tensions. Specifically with the election, the policies around tariffs and trade and deglobalization, that could start to impact markets a bit here in the next couple of months. So when I look at this holistically, at the whole picture, it does seem like we're in for a period of more extreme volatility. 2% up, 2% down days might become the new normal. Now, we did get some good news, at least on the geopolitical front. Israel's Prime Minister Netanyahu accepts elements of a new U.S. truce proposal. Now, why is this good news? As I've said before, these Middle East conflicts and tensions, they really don't have anything to do with our economy. We don't do a lot of business with Iran or Israel for that matter. They're just not significant to the grand scheme of the U.S. economy. So why is this important? Well, there's always that small chance that things could escalate in the Middle East that could cause a larger conflict that could impact potentially our economy. Call it a 0.5% or a 1/3 of 1% chance of all-out World War III because of this conflict. In all reality, the odds are maybe closer to like 2%, 2.5%, but still, it doesn't matter what probability you put on it. If this conflict does settle down, if the whole region settles down, I think the markets will look at that as a positive. Ritholtz Wealth says flash crashes are getting faster. Flash crashes happened in the 1920s, they happened in the 1960s, and they happened today. They also say we are likely to see more of these flash crashes in the future due to a combination of increased leverage in the system, globalized markets, and computer training. And August 5th was actually the 4th largest single-day gap down since 1982. Even though we're almost back to new all-time highs, August 5th was a real panic moment. And yes, I think a lot of that was the yen carry trade that was blowing up, but some of that does have to do with growth concerns. And if you do see more bad data, you will get big down days. If you see Fed Jerome Powell say the wrong things, you could also get some pretty big down days. So the main event by far this week is Jerome Powell's speech at the Jackson Hole Economic Symposium. That is this Friday at 10 o'clock in the morning. Markets are currently assigning a 25% chance of a 50 basis point cut and a 75% chance of a 25 basis point cut. And as I've said on this channel before, a 50 basis point cut is probably going to be seen as bad news because we still have 4 weeks, 3 days, 1 hour, and 44 minutes to be super specific before the next Fed rate decision, September 18th at 2 p.m. Now, if we start to price in a 50 basis point cut, that's because the economy is weakening further between now and then, essentially over the next 4 weeks. And again, each and every single bit of economic data will push around these odds of either 25 basis points or 50 basis points. But we know for sure the Fed will be cutting rates September 18th. If for whatever reason the Fed does not cut rates, which would really be like a black swan event at this point, that would be a much bigger problem for markets. But I don't really think that's even a topic worth discussing at this point. It's more so, do we get 25 basis points or do we get 50 basis points? And 50 basis points may be a negative because you want a Fed that does not signal they're behind the curve. You want a Fed that does not signal panic or worry about the economy, about how restrictive we are, even if they are worried. You want the Fed to come out and say something along the lines of, we are going to start reducing rates. We need to normalize Fed policy to, account for the fall in inflation we have seen, but we don't need to rush to do so. We can systematically start to move rates lower. The last thing you want is the Fed that comes out sounding panicked that they need to rapidly start cutting rates. And I don't think that's the Powell that we're going to get. You also don't want to see a Powell that is super data dependent as well. Inflation is basically gone at this point. It's last year's problem, to quote Ryan Dietrich. You want a Fed that actually commits to cutting rates. You also want a Fed that commits to being a backstop for markets. Any major crashes or recessions or economic disasters or events for that matter over the past, call it 100 years, have stopped when the Fed backstops markets. Now, from the Fed's perspective, the last thing you want is to cause the markets to fall. Like the Fed this Friday does not want markets to crash because of anything he says, right? The Fed doesn't want markets to crash at all because then they would be forced to cut rates faster and that would not be good. So in fact, I think this speech from Powell on Friday, at least half of it is just going to be to reassure investors, reassure markets. Because again, if stocks go through a larger crash, that in and of itself can be a catalyst for a recession. The last thing Powell wants is his legacy to say he was too late to raise rates, he crashed markets, caused a recession, and we went through a period of economic pain because of it. So again, I think half of Powell's job this week is just to calm down markets, to let markets know the Fed is here. They will backstop our markets if they have to. They will do whatever they have to avoid a larger downturn in the economy. The Fed has been so focused on inflation over the past 2 years with very little mention of the economy. I think we're going to get a much different Powell that comes out and basically says, hey, we've got inflation under control. We'll respond to inflation if we need to, but right now we need to manage the business cycle. We need to make sure that there is not a larger slowdown. And let's say something like this. Okay, Powell, if you're listening, I'm sure you're not. We will do whatever we have to support the economy and ensure a soft landing. If he says something along those lines, it could be off to the races for markets. Now, at the same time, I will tell you the last two Jackson Hole Economic Symposiums have not been good for markets. So in 2022, that was the peak of the bear market rally in August, and then you ended up hitting the lows around October. Okay, not great. The last Jackson Hole Economic Symposium, again in August, that was after quite a rally from the October 2022 lows. What happened? You ended up falling to the October 2023 lows. From peak to trough, that was about 11% downside. Now, we did 10% downside, this 10% correction in a very short amount of time. You've bounced back a lot. So I do think the risk here is that markets could just sell whatever Powell says. Usually, when the Fed does cut rates for the first time, it is a risk-off move for markets. So that's why it really just depends on how the Fed really messages this, okay? If the Fed, is forced to cut rates faster than expected because the economy is weakening, that's going to be a risk-off event when the Fed does cut rates. You really need a Fed that comes out and backstops markets, that tells investors clearly, like, we will buy assets if we have to. We will do whatever we have to if that becomes appropriate. And markets, would really like that. But again, as you have rallied 9% off the lows, there is a higher likelihood now that you can see a bit of a fall after Jackson Hole compared to if we were down 10% heading into Jackson Hole, right? Just on a pure statistical probability basis, after rallying so much, you're more than likely going to sell off. You don't have to, but you're just more than likely going to after a very aggressive move higher like we've seen in a very short amount of time. Compared to if we were trading at the lows, there would be a much greater likelihood of seeing a bounce on Powell. And that's why I think the first couple of days of trading this week will be so important, because we bounced a lot. If we do sell off a bit heading into Powell, then that could create a higher odds that Powell is actually a positive catalyst for markets on Friday. But for this week, Monday, Tuesday, you really don't have much of anything. A couple Fed speakers here and there, but that's it. On Wednesday, you have the FOMC minutes. That's really not a big catalyst at this point, because this is the transcript of the last Fed meeting for anyone that does not know. And that's backwards looking. There's a lot that has changed from the last Fed meeting. I don't think the markets are going to care about the FOMC minutes at all, to be honest. Thursday is the day in which you could see a lot of volatility. You have the Chicago Fed National Activity Index, expecting that to come in at 0.2 negative, so worse than last month. Initial jobless claims are expected to fall 2,000 from last week, from 227,000 down to 225,000, so that would be good for markets if that happens. Continuing jobless claims are actually expected to rise about 20,000, so that's strange. A drop in initial jobless claims, a rise in continuing jobless claims, not something you see all the time. S&P Global Composite PMI is expected to fall a bit from last month. S&P Global Manufacturing PMI is expected to fall a little bit from last month. And S&P Global Services PMI is expected to fall about 1 point from last month. This services data is going to be the most important because manufacturing's been in a recession for a while. Areas of our economy have been in a recession for a while. Some call it the rolling recession. Services have not been. If services do start to get worse from here, that becomes a larger problem for the U.S. economy. I don't think that's going to happen, but if the data starts pointing in that direction, Wall Street will not like that. You will also get existing home sales for July and existing home sales month over month, as well as the Kansas Fed Composite Index and Kansas Fed Manufacturing Index. Both of those expected to get a little bit better from last month, but still be in deep negative territory where they have been for like 2 or 3 years now. So not expecting much of a change there. So Thursday is really the economic data day, the day in which you could see volatility heading into Powell. Again, Powell is Friday, 10 o'clock in the morning. You do also have some earnings this week. You have Palo Alto Monday in after hours. You have Lowe's Tuesday pre-market, Toll Brothers in after hours Tuesday, Wednesday pre-market, Target, Macy's, TJX, Wednesday and after hours, Snowflake, Zoom, Wolfspeed, and Synopsys. Urban Outfitters, couple other names as well. Thursday pre-market, you have Baidu, Peloton, Advanced Auto Parts, BJ's, Canadian Solar, TD Bank. Thursday and after hours, you have Kava, Workday, Bill.com, Intuit, Ross, and Red Robin. And then Friday, you have a couple names there as well. So this week is a big retail week again. Lowe's, Target, Macy's, TJX, Ross, right? Even Kava to a certain extent. You want to see these earnings come in good. You don't want just Walmart to be the only one with good retail earnings. That's not sending a very strong sign, because if you recall last week, people were saying, hey, if Walmart has bad earnings, that's bad. That's like really bad, because Walmart should be the last place that has bad earnings in this kind of environment, because everyone's shopping at Walmart for lower prices. But if Walmart has good earnings, that's not good either, because everyone's shopping at Walmart because they're broke. But let's say Target and Macy's, TJX have good earnings. Lowe's is kind of grouped in that Home Depot, home improvement category, so they're not as important in my opinion. But let's say these three retailers have good earnings. Then we can say maybe it's not just a Walmart story. Maybe the consumer is actually doing okay after all. And I think that's obviously going to be the biggest driver of markets coming on Wednesday. Now, if they have bad earnings, more fears about the consumer are going to come on. Currently, CNN's Fear and Greed Index is sitting in fear territory at 35, and the percent of stocks currently trading above their 50-day moving average is at 56.63%. You were actually up 1.5% on Friday, and you're in kind of a neutral place. About 50% of stocks are in uptrends. And there's definitely room for this to get better or to get worse. So I really think it could go either way. It really just depends on earnings, really on Wednesday, economic data on Thursday, and Powell on Friday. I do think bottom line for Powell, and from the market's perspective, you want to see Powell that is confident inflation is not a problem anymore. Again, we've spent years thinking about inflation as the lion's share of the Fed's problem. We want the Fed to really not cause panic about the economy, about economic growth. Not say, you know, shit's hitting the fan where it's going to get worse from here. You obviously don't want Powell to say that. If that's how they feel, then wow, that would be a real change up in just a couple of weeks. So don't expect anything along those lines. But you want a Powell that reaffirms, reassures investors that the Fed will do whatever they have to do to ensure a soft landing. That inflation has fallen so much that it's no longer an issue, that the Fed can respond forcefully if there is, you know, degradation or deterioration in the economy. That's what the markets ultimately want to hear. They want to hear a Fed that is not panicked to start cutting rates 50 basis points at each meeting, but a Fed that can take the approach of slowly cutting rates 25 basis points each meeting. Now, again, I think the Fed could talk the markets into a larger initial rate cut to get the process going. I don't necessarily think that would have to be bad news. It just depends how the Fed kind of outlays that, right? If Powell comes out Friday and they say, hey, we should probably do a bigger cut, not because the economy is weakening, but because we just want to get closer to neutral. Just do a big first cut to put some pressure off the economy. I think there's a way the Fed could engineer a 50 basis point cut and it wouldn't be bad. But you want to see a slow and steady process of cutting rates. That's what gets you the soft landing, and that's what will get Wall Street excited. You don't want a panic Fed. You want a Fed that is not worried about inflation anymore, and you want a Fed that's really going to, again, backstop markets if they need to. And you want a Fed that is confident that they can do that if they need to. And I think that's the Fed that we get. But have we priced that in markets? I mean, you've rallied 9% from the lows. Perhaps. Now, I also think it's worth mentioning that mega cap tech does not benefit when the Fed lowers rates, okay? When the Fed has been raising rates, these mega cap tech names have had, hundreds of billions of dollars in T-bills just collecting these 5% yields for the over a year now. It's actually helped their bottom line profitability. When the Fed cuts rates, it doesn't boost their business demand, right? It's not going to do anything for them. They're self-financed. Like that doesn't help them either when the Fed cuts rates. There could be less chance of a recession if the Fed starts to cut rates. All of these reasons could have negative impacts to big tech, but positive impacts to cyclicals, to value stocks, dividend value stocks, to growth stocks that are more leveraged to financing. Basically everything else besides big tech. So I agree with someone like a Tom Lee that thinks the real risk to reward in our markets could be in the Russell 2000 or in an overall broadening out. Now, I don't think it's going to be as aggressive of an outperformance in the Russell that we seen just a couple of weeks ago. It's not going to be vertical 3% up days back to back to back. It's not going to be like that, okay? But it will be a outperformance of, those areas. Growth tied to financing, right? Tied to interest rates, consumer cyclicals, value, dividend names. They will outperform big tech if we do have a soft landing. And that's where you would want to be positioned, in my personal opinion, if we do get a Powell that I think we're going to get. And that is a confident, accommodative, vigilant, and less worried Powell on inflation. So I'm actually optimistic that this week could be a pretty good week for markets. I wouldn't be surprised if we hit new all-time highs, or I wouldn't be surprised if we fall quite a bit as well, because you've already rallied 9%. But I do think if there's one area that would benefit the most, it's everything besides big tech. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great rest of your day, and I will see you in the next one.